Let's hear from Samir Gadio. He is an emerging market strategist at Standard Bank. Thanks very much for being with us, Samir. So why is the Nigerian doing this, opening up the way for more foreign investment?
Well, I think the rationale is that the Naira, the local currency, came actually under pressure in recent months. And so the central bank realized that it would be difficult for them to actually keep a relatively flat exchange rate at 150 plus minus against the dollar, unless you had any substantial capital inflows.
So they want capital inflows to increase. Is this loosening up of the restrictions going to work? Is there appetite for investment in Nigeria?
I think there is. I mean, the restriction was on the fixed income inflows specifically. The equity market was liberalized a long time ago. I think there is because the yields are in double digits. You have a relatively liquid secondary market, probably the most liquid after South Africa in that space. I think the only concern is that the fiscal position of the country is somewhat loose. So some foreign investors might be worried about the FX reserve position, etc., especially because the oil price declined a little bit in recent weeks.
The fiscal situation is loose. Just elaborate on that, will you?
Well, as in most emerging and frontier markets, actually the authorities implemented counter-cyclical fiscal policies after 2008 and 2009, which was fair at the point, at the time. But the fiscal expansion has been extremely substantial over the last 2 years, and I think it's just starting to turn now. The 2011 budget points to some fiscal consolidation, and the Nigerian authorities have actually launched a sovereign wealth fund just recently.
All right, so they've got to step up efforts to pay for all those programs. What can you tell us about the Nigerian economy? I mean, we know that it's Africa's biggest oil exporter. Is it a one-dimensional economy, though?
I mean, yes and no. Oil accounts for about 95% of total exports, 80% of government revenue, and only 20% of GDP. So actually, from a GDP standpoint, the economy is much more diversified, but obviously oil remains the primary driver.
And we have had some positive developments on the oil front around the conflict with the Niger Delta rebels.
Yeah, absolutely. In 2009, at some stage, oil production fell to 1.65 million barrels per day, and it's now back to 2.1, and that's excluding LNG, actually.
And is that an unstable situation, or is that something that that seems to have improved for good?
No, I think it's actually improved quite a lot. Production has been in excess of 2 million barrels per day for several months now.
Now, the other bit of GDP, you mentioned there that oil accounts for about, well, Morgan Stanley puts it at about 15% of GDP. And actually, in 2010, Morgan Stanley points out that the wholesale and the retail industry actually accounted for 19% of GDP. So are there investment opportunities in this space?
Oh, absolutely. Well, you have to take into account that, the population size is 150 million people.
The most populous in Africa.
So the consumer story, I think, is there, and there is a substantial upside potential. I mean, obviously, the country is coming from a very low base, and the income inequality is still very high, but there is a very attractive long-term opportunity.
Okay, excellent. We appreciate that insight. Samir Gadio from Standard Bank. Thanks very much for being here.